With these long-term picks, think in terms of years rather than months. These dividend stocks aren't going away anytime soon. The Financial and Investment Wisdom Channel is all about making better financial decisions. If you're looking for financial literacy, growth investing, trading, or want to improve your finances, this could be a great one for you. To avoid the higher tax obligations associated with day trading, investors must hold a stock for at least 12 months, according to the definition of long-term capital gains. However, many on Wall Street believe that true long-term investing is measured in years rather than months. This is evident in the phenomenal performance of high-growth stocks such as Tesla, which has risen more than 1,300% in the last 5 years despite experiencing significant short-term volatility. However, buy and hold investing can be a lucrative source of profits in both mature dividend stocks and disruptors like Tesla. Because of their stable business and generous dividends, these sleepy mega-cap stocks frequently provide consistent long-term returns. If you're a long-term investor, consider one of these 7 dividend stocks, which are so well established and stable that you can hold them for as long as you want, perhaps even forever. AT&T, stock symbol T. Let's face it, AT&T is the leading wireless provider in the United States, accounting for more than 40% of wireless subscriptions, and it's not going away. Sure, its competitor Verizon isn't far behind. Even if the number 1 and number 2 providers ever switch places, neither is going away anytime soon. The demand for data is constant in the digital age, making AT&T's revenue stream extremely reliable. Its dividend is also not going anywhere, with payouts of $2.08 comfortably under the $3.15 in projected earnings per share this year and accounting for only 66% of total profits. Long-term investors can rely on AT&T for many years to come in an industry where customers are very sticky and the barriers to entry for new entrants are incredibly high. Abbott Laboratories, stock symbol ABT. Abbott Laboratories is a dividend aristocrat, having increased dividends for 49 consecutive years. The corporation is one of Fortune's top 50 most admired companies. For the past 8 years, it has ranked first in its industry. Those are some impressive accolades. However, it is even more critical that Abbott is the market leader in all of its businesses. Abbott is the undisputed leader in cardiovascular care, diabetes care, diagnostics, and nutrition. To be sure, Abbott's dividend yield of 1.4% is unlikely to tempt you. However, the dividend will almost certainly increase over time. Even better, Abbott is expected to deliver substantial revenue and earnings growth, which will pave the way for strong share price appreciation. Coca-Cola Company, stock symbol KO. Warren Buffett and his Berkshire Hathaway investment firm invested $1 billion in Coke stock in the late 1980s. Berkshire's stake has since grown to approximately 9% of the total number of KO shares outstanding. The fact that Berkshire and Buffett have been riding high on KO stock for so long demonstrates that this is a stock to buy and hold indefinitely. But just in case you need more evidence, Coca-Cola recently announced its 59th consecutive annual dividend increase in February. Furthermore, those regular raises haven't been paltry. KO now pays 41 cents per quarter, up from 17 cents at the start of 2007, just before the financial crisis, and nearly double the 22 cents paid a decade ago at the beginning of 2011. Given that KO increased its dividends during the current pandemic, the Great Recession, and everything in between, the iconic consumer corporation has received a decisive vote of confidence. Home Depot, stock symbol HD. With $140 billion in annual sales across nearly 2,300 stores, Home Depot is the leading home improvement retailer in the United States. While HD is a cyclical stock that may experience some short-term ups and downs due to the housing market or spending trends, it has proven to be a tremendous source of profits in the long run, thanks to dividends and share price appreciation. Consider that HD stock has risen 760% since 2011 compared to about 200% for the S&P 500 during the same period. At the same time, dividends have increased from 25 cents per quarter in 2011 to $1.65 per quarter today. Whatever you think about short-term volatility, this is a stock you want to buy and hold for the rest of your life with returns like that. Intel Corporation, stock symbol INTC. Over the last year or so, there has been a lot of speculation about whether Intel has what it takes to stay relevant now that it has floated the idea of exiting the chip-making business. However, the hard reality is that the real money is made in designing and patenting premium microchips, rather than simply manufacturing them. This is why Intel, with its extensive intellectual property, is valued many times higher than smaller foundries with razor-thin margins producing chips designed by others. It's also why Intel's dividend has increased from 18 cents in 2011 to nearly 35 cents now, because those semiconductor patents are in high demand and generate consistent income like clockwork. Unless you believe Intel's best-in-class designs will be phased out or those products will use fewer chips in the future, it shouldn't matter whether INTC prints the chips itself or not. Given the ever-increasing demand for these products in the digital age, Intel is a stock to buy and hold in perpetuity. JPMorgan Chase Co, stock symbol JPM. JPM emerged as the most resilient financial stock on Wall Street during the 2008 financial crisis, when several banks, including Citigroup and Bank of America, took significant hits. For example, despite cutting its dividend during the worst of the chaos, it was back to pre-crisis payouts of 38 cents per share by 2013 and now pays a very generous 90 cents per share. At the same time, if you look at JPM stock since the beginning of 2007, you will notice that it has outperformed the S&P 500 as a whole, whereas B of A and Citi are significantly underperforming when compared to 2007 levels. This demonstrates that JPM has the potential to be a very long-term investment. Brookfield Renewable, stock symbol BEP. Brookfield Renewable lacks Abbott's track record of dividend increases. However, over the last 2 decades, the company has increased its dividend distribution by a compound annual growth rate of 6%, and most investors will probably like its close to 3% yield. But there is one thing that Brookfield Renewable and Abbott have in common. Its long-term growth prospects are even more appealing than its dividend. Almost 130 governments have set net zero carbon emissions targets. Nearly 3,100 businesses have pledged to reduce their carbon footprint in half by 2030. This represents a vast opportunity for Brookfield Renewable, one of the world's leading renewable energy providers. Brookfield Renewable anticipates long-term total returns ranging between 12 and 15%. With the growing demand for renewable energy and its massive development pipeline poised to provide significantly more capacity, the company should be well-positioned to meet that target. Johnson & Johnson, stock symbol JNJ. Few companies have a more impressive pedigree than Johnson & Johnson. It is a dividend king, having increased dividends for 59 consecutive years. On Fortune's list of the world's most admired companies, J&J is ranked first among pharmaceutical companies. It is the world's largest healthcare corporation. Johnson & Johnson is about as consistent as it gets. Approximately 70% of its sales come from products that rank first or second in their respective markets. The company has 28 products or platforms with annual sales of more than $1 billion. It's also a surprisingly agile monster. Over the last 10 years, the company has delivered an annualized total return of 13.1%. Products launched in the previous 5 years account for roughly 1/4 of its total revenue. J&J should be able to produce consistent long-term earnings growth. Add to that the company's attractive dividend yield, which is currently close to 2.8%. This blue-chip dividend stock is one you'll almost certainly never regret purchasing. Procter Gamble Company, stock symbol PG. P&G is in a class by itself when it comes to consumer staple stocks, with a diverse and robust portfolio of products that include, among others, Gillette shaving products, Pampers diapers, Tide detergent, Tampax feminine products, Herbal Essence, and Pantene hair products. To summarize, almost everyone who goes to the grocery store returns with something from PG in their shopping bags. While there isn't a lot of breakneck growth or innovation in personal care products, there is undoubtedly dependability. That adds up to a steady stream of cash in good and bad times, powering a generous dividend you can count on for the foreseeable future. With $70 billion in revenue and roughly $17 billion in operating profits per year, this stable dividend stock isn't going anywhere. Nvidia, stock symbol NVDA. Headquartered in Santa Clara, California, Nvidia is the world's leading graphics processing units, GPUs, manufacturer. Its chips are used in various applications, including high-end gaming PCs, data centers, and automotive infotainment systems. Nvidia, well known among gamers for its high-quality GPU graphics cards, has benefited significantly from the cryptocurrency frenzy, particularly earlier this year. Its chips are famous among cryptocurrency miners. Furthermore, they are critical in artificial intelligence, AI, medical research, and data centers, as well as self-driving cars. Prologis, stock symbol PLD. Based in San Francisco, California, Prologis is a global developer and operator of industrial and logistics facilities. It was founded in 2011 as a result of the merger of AMB Property and Prologis Trust. The company owns many real economy assets such as warehouses and distribution facilities. As the industry leader in logistics real estate, e-commerce companies are increasingly reliant on the company. According to a 2020 report, the current economic value of goods flowing through Prologis facilities worldwide is $2.2 trillion, a 69% increase over 2017. This $2.2 trillion throughput represents 3.5% of the GDP of the 19 countries in which Prologis operates. We will teach you the fundamentals of financial terminology and how to get started. You'll also learn about cryptocurrency trading and investing, growth stocks, and how to be economically confident. So be sure to subscribe so you don't miss a single upload. For the time being, sayonara.